about repricing. We talk about the New World Order. We talk about how massively outperforming commodities have been in this past year. And here we are already, barely at the end of January 2026, and we are already seeing things like platinum up by double-digit percentages, silver up by double-digit percentages, gold hanging in there, trying to get through the horse race. But there are reasons for this. So I want to talk a little bit about that, and then I'm going to do a lightning round of our top 10 commodities and why and how they fit into what we are seeing, which is a structural deficit in supply and in the time it will take for miners to get up and running if they are not already, to get permits if they don't have them already, where they are at in the pecking order from having them to moving up through potentially being acquired or growing themselves organically, because there is just so much going on up the entire, not just supply chain, but value chain of commodities. And it's happening right now while you are in this room. So I want to go through that. But first, I just want to take you back a little bit to historical times. I am also a historian. And so when I look at trends in the marketplace, and particularly with hard assets and commodities, I like to look at what happened in the hard asset spaces at the times in history where they had the most movement before, and to make comparisons and to move past that in terms of where they have gone today, literally today, and where they're going to go over the next year and over this next very big cycle of commodities that we are in. So if you have not invested in many of them or all of them, you are not late. So that's one thing that's important to remember. About 150 years ago, there was a major change in North America in terms of commodity development, and in particular, aligning North America with the gold standard, with the idea of having a hard currency, which was actually hard, which was backed by actual physical gold. And there were a number of mines in Canada and in the United States, including the Homestake mine, which is being resurrected right now, actually by a company that's here, Dakota Gold, to fill what was a geopolitical gap at the time of Europe really controlling all of the lending for the industrial age and development in that capacity, and railroads and so forth. And the United States, which was trying to borrow money, was in debt after the Civil War and needed to find a way to secure that lending, to secure that debt, and that became gold. So in 1900, something called the Gold Standard Act was passed by the United States, and it helped all of North America, particularly the US and Canada, calibrate to what was already happening for decades and centuries in the United Kingdom, in emerging Germany, and throughout Europe. That basically was what financed a lot of the Industrial Revolution across the Atlantic and across the world, and it resituated North America and the United States to be effectively towards the top of that pecking order in terms of being a creditor, acquiring debt, and building the real economy on the back of real assets, on iron, on steel, on oil. And David Rockefeller at the time cottoned on something very important that I see happening today, and that is that you don't just control the commodity. You don't just buy the raw material. You basically get involved in the entire supply chain. And the companies that are doing that, or that have partnerships that are long-standing with experienced management that are doing that, are the ones that we see jumping ahead in this particular cycle. So for example, what he did not do is buy a lot of oil. What he did is he became a refiner, he became a producer, and he got funded up the supply chain so that he could incorporate that into growth, into getting credit, and into expansion throughout the world. Now, there were issues with it, there were breakups in Standard Oil, and things happened along the way, but the pieces still exist, and the lesson of having a real commodity supply chain control is very, very prevalent today geopolitically and actually with respect to all of our commodities. So I'm going to talk about 10 commodities that we're focused on at Prince Heights Global, which are effectively ones you all know and love mostly, and maybe some that you're not necessarily invested or watching too closely yet. But what they all have in common is that the reasons for their appreciation is not merely because the dollar's going down. That is absolutely a component. It's not merely because there is uncertainty throughout the world and geopolitical uncertainty with tariffs, with wars, with organizational fights for the commodities underneath the ground and for the supply chain. But a lot of things combined all at the same time. So when we looked at putting our forecast together for this year, which we put out in the beginning of January, we were wrong on one thing, which is we had silver at the top of our list, and we had a forecast that we were going to potentially change in 6 months, which was $120. Now, as I stand here, it's definitely creeping up towards that level. We will probably move it up, and if you were here yesterday, you heard me say 180. I didn't pick that number out of a hat. This is a number that we are tracking as a potential high point of where silver can get to this year. And it is our top favorite commodity. And that is because of the dual uses that silver has. It's because it has the industrial use circa today, and it had kind of an equivalent to the steel and iron circa early 1900s. Of course, those things still exist, but in terms of the momentum, the appreciation, silver has that dual capacity. Also in terms of reserve currencies, we talk a lot about gold being a reserve currency. It absolutely is. This year, the central banks around the world hold more gold than they hold U.S. Treasuries in terms of value. They also hold more gold. That makes gold the number 2 currency in the world, just below the dollar in terms of reserves. That is a big deal. It was not like that 4 or 5 years ago. This is definitely a momentous change, and it's something that's going to continue to accumulate. Silver is not a reserve currency yet. It was a reserve currency back in 1900 when gold became the standard of the central banks that existed at the time. Of course, the Federal Reserve, the U.S. central bank, didn't exist till 1913. But the other ones that existed were able to accumulate silver as well as gold. Gold became the number 1 collateral because it was consistent throughout the world, but silver was definitely a very strong number 2. So we have the possibility, and I've been talking a lot with the BIS and officials there about whether or not silver can get reintroduced as a reserve currency and count as Tier 1 capital for central banks, which will give it another bid if that happens, whether it's this year or next year, or even the conversation just gets out into the world. It has the potential to continue to lift silver up, in addition to the industrial capacity that silver fills, and in addition to the fact that we're at the 5-year supply chain dearth. 200 million shortfall ounces of silver a year going into the 5th year, and mines not being able to come on quickly enough to make up for the shortfall today, and that's without growth in industry, that's without growth in AI, that's without growth in data centers, which we all anticipate will happen. So that's that. Uranium is our second. There's a lot of uranium companies here, and uranium has the dual nature of the fact that it's a geopolitical lag as well. It's something that North America, Europe, Asia, everybody wants more enriched uranium. They want to be able to incorporate into their nuclear energy systems. Nuclear energy today fuels 20% of electricity in the United States, a little bit less than that, but double digits almost throughout North America. So it's not simply a national defense energy. It is everybody in this room potentially energy as the base load, i.e. the most secure type of fuel that's coming into new technologies for energy. So we see uranium being also having a lot of momentum, and the areas with the best jurisdiction and permits and ties to the governments, because it does get government financing, and it has gotten that more and more here in Canada, in the United States, through deals, through executive orders, through funds. And it will continue to do that. So again, going down that supply chain to the value of uranium, that is definitely an upside. Copper, number 3. Now, copper, of course, electrifies everything, and our needs for electricity continue to grow. Also a dearth in copper. Right now, we anticipate that copper will be required to accumulate by 30% more than it currently is today, where there is very little new supply coming into the market. So if you do the math on a 30% appreciation by 2030 of the need for copper and a dearth of copper right now, the value of copper in the ground and close to getting above the ground, and specifically companies that can process it internally or have AK David Rockefeller, a flow in place that allows them to also handle the processing, that's going to be important. That's going to have tremendous upside as well. 4, we come to platinum. I love platinum. Platinum outperformed for a second. Silver towards the end of the year, again, neck and neck. Platinum was ahead, just kind of came back a bit relative to silver. There was a profit taking at the end of the year, et cetera. But already we're seeing that come ahead this year. And why? Because geopolitically, there's not enough platinum to work on the converters that we have in our cars, that we have in military technology. The idea of having hybrids, so not just EVs, but hybrid technology requires platinum in order to function. We don't have enough platinum. And also platinum is concentrated, and it's important to always consider jurisdiction risk and concentration risk in any investment in any mine in South Africa and in Russia, and there is not enough that is processed anywhere or out of the ground anywhere throughout the world. So when you find mines that have that, whether they're in Canada where there are a couple, whether they are in Brazil where there are a couple, those are the platinum mines to consider as well as the commodity itself. 5 is gold. It's not because I don't love gold. It's because gold will continue to accumulate, but in price, but the story of gold is now one that's sort of baked in. So we're going to continue to see appreciation. I said yesterday, if you're here, I'll say it again, that we do see gold getting up to $6,000 an ounce this year. But more importantly, again, jurisdiction, again, geopolitics. Why do nations need gold? Why were central banks buying gold over the last 3 or 4 years? Why were they getting rid of their treasuries? Lots of things monetarily, and also because of physical supply. Everyone in this room, it all always goes back to physical supply, where it is, where it's going, how much new supply can come on market to meet demand from wherever it's coming from. So central banks have gone on a tear of buying 1,000 tons a year. The expectation this year, and JP Morgan had this out, they're sort of the closest thing to monitor the big banks in terms of their forecasts. What they tend to do is follow our forecasts, I think, but I don't know that they do this for a fact. But they have talked about a 750-ton increase. I think it's going to be way higher than that because I'm watching central bank activity. I'm looking at the chaos in the world. I'm seeing the accumulation. I'm seeing the buying of new mines and new supply and the securing of supply coming up. And what that means is these banks are trying to tie in supply. Add to that the fact that, for example, Morgan Stanley told their customers at the end of last year, forget the whole 60-40 equities bonds thing. We never have recommended bonds. I hate bonds. I worked on Wall Street for very, very long. And bonds are just, not even just U.S. debt, bonds in general are just generally not a place to be. But anyway, they've talked about it being now that 40% bonds divided 20 to 20. Now, if you start dividing 20-20, meaning 20% bonds as a suggested allocation to their customers, to their institutional investors and so forth, and you cut off 20% for commodities, well, they've got to look for stuff. And that means JP Morgan has to look for stuff because they have even more clients. And that brings me to rare earths. So rare earths is really interesting because there was breaking news today in the rare earth space where the United States is investing $1.2 billion in a company called USA Rare Earths. They already invested last year $1.2 billion in a company called MP Materials, which I'm sure all of you are familiar with. What is interesting about those two deals are two things. One is it's the United States kind of doing what it did back in the gold standard days, which is saying we are going to pay for future supply. The Gold Standard Act got passed back in the day because the United States Treasury was like, we cannot compete in the world if we do not secure supply. So they started funding supply. They started funding the supply chain. They started funding explorers throughout the country. And what's happening now is they are funding processors as well as tying up rare earth offtake agreements. Now, I happen to be on the board of one rare earth company that isn't here. It has a project out in Brazil called Meteoric Resources, and the project there is not fully developed yet, but it is something that has interest from Australia, from Brazil, from the US, because it is future supply. And it allows for supply to come offline from China, which controls 60% of supply, and 90% of processing. So there is a lot of muscle. It's not just from the US, and Canada has a critical minerals fund. It is not just from the government side, but it's important when you look at investments. If you're looking at any miner, you've got to look for jurisdiction. You've got to look for experience management. You have to look for, is there government or will there be government backing, as well as private momentum, like from JP Morgan. Now, on the back of that rare earth deal, going into that rare earth deal, JP Morgan opened a $1.5 trillion fund for over 10 years to invest in critical minerals. That affects literally everything I've just talked about so far, except possibly gold. Gold is the only one so far that is not on the U.S. critical minerals list. But if JP Morgan, one bank, has committed to $150 billion a year of investment. That goes down the chain. If Morgan Stanley is talking about dividing all of its bondholders into half and half, bonds versus commodities, that goes down the supply chain. If central banks open up their reserve policy, that goes down the supply chain. I have 4.5 minutes left. I'm going to do this really quick. Palladium, like platinum, same thing. It has a lot of concentration risks. It's also used as a companion to platinum in converters, and it also has a severe dearth of supply, and it has even more volatility. So if you're in it, be careful, have a big stomach or a tight stomach or whatever, but it is something else down the line. And then we've got aluminum, we've got lithium, and we also have cobalt. What I'm going to say really quickly is aluminum is old school. Aluminum's not going to go crazy, but processing of aluminum, smelting companies that effectively are beyond their capacity and take a decade to recreate, let alone start from scratch, all over the world require aluminum, and that's why it maintains its higher tariffs right now from the U.S. and all countries who are throughout the world trying to protect their aluminum. So that's the thing. Lithium's had some bad years. I think it's coming back because it's a companion to cobalt. Cobalt is basically controlled by the Democratic Republic of Congo, which means that most of the supply comes from one place. Most of the supply coming from one place is definitely a sign that whoever else is producing it is potentially a good investment. And so again, as the geopolitics switch, the need for jurisdictions that are open, that are friendly, that have actual mines at actual production or near production, and many of these commodities, that will take some time, are places to consider long-term investing. And I don't mean like 6 months or a year. I'm talking about future generational wealth creation and preservation. So with that, I've got 3 minutes for questions. I covered all of them, all of our favorites, not to disclude any other really important commodities out there, but I throw it to you if anybody has any questions in these last few minutes. So the question is, in general, if gold is responding to what's going on with Japanese bonds and their over-exuberance in terms of their debt, I'm paraphrasing, and whether that is one of the impetuses for rising in gold. Every single bond problem, every single bond crisis, every single debt accumulation, every single debt to GDP right now, given the geopolitical propensity to diversify into gold and be involved in hard assets, is a contributor, not the contributor. What we're seeing in gold now, which is why for us it's 5 and not 1, is that there are multiple contributors at any one moment. There's 2 good things about that. One, if you do have a light stomach, investing in gold is great because it's going to continue to go up. The best mines are going to continue to appreciate right now into that supply requirement. And also, the dips are not quite as substantive when and if they occur with general market volatility because there are so many factors, Japan, the US, China, people, that are involved in keeping gold prices up. That's a really great question. I actually had this on our Substack this morning. Someone was like, well, it's all very nice and good that you're talking about forecasts up. What happens in the meantime? What's your exit strategy? So what we do and what I suggest, and everybody makes their own decisions about investments, is if something goes up by double, you take a percentage off as cash. It's a very vanilla rule, but we do rotate. Sometimes we look at stuff going up like we just did 150 or 160% merely because it moves so fast, but that you do take off some of those profits. You keep the rest riding if that seems like the right thing to do for other factors at the time, and you use it for either corrections or dips or wherever the next investment might come. Now that's a very sort of generic answer, but it is important, and this is about your own risk tolerance. It is important to take profits, to take cash off, even when things are going crazy, like even in silver. I don't know how many of you heard Rick Rule talk about how he has sold like 80% of his physical silver position. He didn't leave silver. What he's done, I'm paraphrasing for him, but basically taken some of the profits out of the physical commodity in which he's been invested in order to go down that value chain. Again, to find good jurisdictions, good management change, good mines near permits to invest further down that chain because he believes in the commodity, but he's taking off cash to go there. One more, I think. Okay, so the question is fiat currency dying. I see people coming in really quick. We are having a panel actually on that today at 4:50, so if we can talk more about fiat and dollars and gold then. But here's the thing, whether it dies or not, it's definitely depreciating. And whether or not the dollar is ultimately replaced by gold or a gold standard, absolutely, it is every day being demoted for central banks, and right now, and every day being demoted for governments and basically being replaced by gold. So something about gold again. Anyway, I have to go. Thank you so much for your time. I'll be at the other stage at 4:50 if you have time for that. Thank you.